Hi everyone, I hope you're all doing well, and today I'm doing a little bit of a different video to what I normally do. Normally I'm kind of talking about individual stocks, maybe some news with that stock and why that stock's kind of moved in share price, but kind of every so often I do a video series where I just kind of talk about useful tips that might help you make money in the stock market. And I do actually really enjoy doing these videos. It's something that I'd like to do a lot more rather than just talking about stocks. And kind of, I know I've got quite a few beginners on the channel, and try and just give some advice out for like helping you with stocks and what to look at, where to go and stuff like that. So I thought I'd do another one of them today. I haven't done one for like a good maybe month, 2 months. So it's something I would like to do more. Let me know if you want to see more of these sort of content from me. If you can smash the like button, that's always a great thing that I like to see, because when there's a lot of likes, I know that that content is what you like, and then I'll try to do more of that content. So yeah, let me know if it's something that we want to carry on and you want to see more of. But there's not many times I actually just kind of like sit down. Well, I'm not sat down today, I'm stood up still, talking about stocks and where to look for key things to make money. So yeah, it's been, like I said, it's been a while since I've done these sort of videos, and I do like doing them. So hopefully you find, even if you're an experienced investor, maybe some tips that will be very useful to you. The videos tend to go a little bit longer than normal, but that's just because I'm trying to pack them with like a lot of content. So yeah, we'll see how long the video actually goes on for. But like I said, I'm going to give some of the key things that I look for in a company when I am buying a company. And some of the key things that I'm trying to share with you today is the stuff that I use quite often. So the companies that I look for, I'm talking from a like 2 to 5 year kind of view. And these are the sort of things that I would have used when I'm looking at companies like JD.com, which I'm currently up 300%. Pinterest, which I'm currently up about 150%, Microsoft that I'm up about 100% on. These are the kind of the key things that I use when I was looking into them companies and got them return from. And even previously in the stock markets, stocks like Win Resorts, which were 105% gain, Square another 140% gain, Tesla, Ferrari, all the kind of companies where I've got like a massive gain on the share price. These are the kind of the things that I built up from years of experience of investing, and I'll share them with you guys today. So my thinking, and probably the key thing when I go into a company, is I always go into a company or a stock when I'm going to buy it, and always through the process, I'm always running this through my head. I always think, how am I going to make money on this company? Because when you buy into a stock, that's what you do it for. You don't buy it because it's fun. Sure, you might enjoy it, but you'd still rather make money, and it's the reason why we all do it. It's why we put our money into the stock market, is to make more money. And that's the whole reason. When I buy a company, I look at the company and think, how is it going to make me money? And obviously the way that we make money in the stock market is by seeing the share price. More than likely, if you're an investor, you could do dividends, but more than likely the reason why you're looking at gains in the stock market is to see the share price go up. That is the way you make money. If you buy a stock at $20, you want to see it go up to $40. You want to see that share price increase over 2 to 5 years. That is why we invest into the stock market. It's money at the end of the day. So I always go into a company or buy into a stock, and I look at what the current valuation is, and I kind of like look at the company and go, so why is it going to do this for me? Why is the share price going to go up? And I have to make a bull case for the company and say, this is what the company has going on, and these catalysts over the next 2 to 5 years is why the share price is going to increase. If I have no catalyst for the company, then the revenue is not going to go up, the profits not going to go up, the share price is not going to go up. The main reason why a company will go up in value is because the profit goes up and the revenue goes up, and the share price will follow, because it will attract investors into the company. If you have a company where the profit is just staying still, then your share price will not go up. Potentially it might go up a little bit, but at some point a company needs to make profit. Same for the revenue. Revenue is definitely one of the big ones. You buy a company, and if the revenue goes up, the share price will follow it. It's the way the stock market works. If you have a company and you buy a company and the profit goes down, your share price will go down. If the revenue goes down, the share price will go down. Now, it might not instantly happen, but with that profit and revenue going up, it will follow the share price. And that's where you got to go into, is you need to find out why that revenue and profit is going to go up, and then you'll see the share price gain. So you've got to look for catalysts in that company and go, well, they're going to be expanded into this country, so the share price will go up because the revenue will increase from there. Something like that, you've got to go, maybe they have more stores, maybe they're planning on opening more stores, maybe they have a bigger customer coming in. You've got to look for them catalysts in earnings reports, conference calls, and that's where you'll pick it up, okay? So let's just take, for example, I'll give 3 kind of bulk cases for a company and why I bought them shares in them company. So Facebook is a big position of mine. I look at Facebook, I see more and more people coming to the platform, Instagram, Facebook. Also, I see the growth from traditional advertising platforms moving to online platforms where they can target audiences better, and that's why Facebook's going to go up in value. So that's like a bull case that I have for like Facebook. But really quickly, there's more to it than that, but I'm just trying to keep it nice and sweet. We'll go with another company that I recently invested in. So another company I recently invested in is a Chinese company called Huya, and they do online streaming. I think more and more people go to online streaming. I think they'll also ramp up how much adverts they're producing, and also we have the new cycle of consoles coming in, leading to more streamers, more people on the streaming platform. Bull case, share price goes up, revenue goes up from there. I'll go for another company as well. I'll go for a UK company that I currently invest in, which is Hollywood Bowl. So Hollywood Bowl, they're currently closed at the moment, and the venues will reopen, and when they start reopening venues, they'll also look in years above to open up more and more venues. They currently have 67 venues, I believe it is, and they're looking to open 5 more over the next 5 years. Revenue will go up, profit will go up, and those are the kind of bull cases that I have on them companies and why the share price will follow. And any company that I've sold previously, I could give a bull case for why I got into that company and why I bought into that company. So it's all about understanding how to make money and why that company is going to make money, and you've got to make that bull case for that company and why it's going to go up in share value. And that's the first thing that I do when looking into a company. The second thing is that you've got to do the graphs, you've got to do the research into it, you've got to do the hard work, you've got to look through the company, you've got to get that bull case for the company. So you've got to look for the catalyst. You've also got to look for certain problems that might be in there with a company. You've always got to look for them as well. Sometimes you'll see some red flags, which we'll talk about a little bit later on why you might not buy into that company, but you're going to have to do a deep dive into that company and get that bull case for that company, why the share price is going to go up. We'll talk about valuation in a little bit, but that's one thing you're going to have to do. Sometimes, you're going to have to read that investor relation page and understand the company. You're also going to have to listen to the conference call. At the same time, you've also got to understand the market. I never buy into markets that I don't understand, because if I don't understand the market, I can't justify the company and what it's going to do. It's one big. Sometimes it has led to me missing out on companies, but I'm pretty sure that I would have dodged a lot more bullets than the ones that I missed out on, just because I don't understand the area. Because if I understand the area, I have to understand the sector and why that company is going to do well in the sector, and that also leads to me understanding a lot of the competition out there. Something like a Facebook, I've got a great understanding of social media, and I can understand the competition. I can understand, like, there's not many players in here, and the platforms that Facebook operate are the majority in that area, so I can understand the sector and how the sector is going to grow, and I know Facebook's competition, and I can see they're going to outperform a lot of the competition in this sector. Granted, there's going to be other companies that do well because it's a big sector, but at the same time I understand very much what is going on there, and that really helps you as an investor. So you have to do the research into your company to get the bull case, and also you've got to know your sector and also know your competition in that sector as well. And when researching into the company, the next point is to look at the company, read the earnings report. You've always got to know your earnings report, because what happens in the short term, if your stock goes down 10, 20, 30%, you've got to have confidence to stick with that company. And the only way you have confidence in that company when it goes down is to know it in and out. And if you know it in and out, you will have the confidence to hold it in them down days and potentially even buy more in them down days. If you kind of just bought a company because your best mate Dave said to you that it's a really good company and it goes down 20%, you're going to be like texting Dave, aren't you? You're going to be calling Dave and saying, why is this stock going down then? But if you understand the company and understand the bull case, in the short term when you see your stock go down, you're like, that's fine. I understand where the company's going in 2 to 5 years. I'm not really bothered. If anything, it's a good thing that it's gone down. And having that knowledge of the company will help you in the really bad days to carry on holding that position and confidence. I see so many people sell out positions they buy because they bought it because someone else said it, and they didn't do the research. They didn't look into the company, and because they didn't look into the company, that's why they're nervous. That's why they are the people that lose money in the stock market. And more than likely, those are the people that go, the stock market's a scam, because they just bought a company that someone recommended on the Facebook forum. It's that simple. So you've got to understand the company so you have the confidence to hold it for the long term, and you know where the vision of that company is. And as well as that, when you look into the company, and especially the conference calls, you will hear some gems in there. So for example, a company that I bought a while ago was InMode. And I was listening to InMode's Q2 conference call, I believe it was. And in that conference call, the CEO actually came on and said, it's quite a funny quarter for us because we had in May and April, we had no income. All the income for this quarter came from June. And you can see the quarter in June was pretty good. And it kind of matched the last June. So he went on to say, like, if we can just carry on this progress from June into July, August, September, we're going to have an amazing quarter. And because of that, you see the share price going up. You saw earnings being pretty good. They came out with preliminary earnings, which were fantastic. And you would have got that heads up from listening to the conference call. So that was, and I was really confident in the company because I heard that, and I bought really heavy because I think if they're going to have a blowout next quarter and the share price hasn't priced that in yet, it's not going to be down here for long, but it's cheap prices right here. So you get little gems like that in the conference call that keep you ahead of the game, and that's what you've got to do. Sometimes you've got to listen to that to get some really key points. So the next is evaluation. Sometimes you can see amazing companies, but you've got to get it at the right valuation. And the valuation is a really tricky thing to do because it's different from whichever sector it's in, to whether it's a growth company, to whether it's not a growth company. It's very hard to cover a whole valuation in one video, but you've got to understand that you pick it at a good valuation, because you might buy a fantastic company, but you might pay a high valuation for it. And the problem is if you buy a high valuation, you're limiting your upside. You're limiting your upside that you might only get maybe 30% gains, 40% gains. But if you can pick a cheap company up, a great company at a cheap valuation, then that's where your max potential comes. And it's like I said, it's very hard in one video to talk about that, but you're going to have to look at key metrics and compare it to some competitors even. And depending on what you're looking at, so if it's an unprofitable company, you're going to have to go through price to sales ratio. You're going to have to look at the growth. Where if it's a profitable company that's a growth company, you can start looking at forward PEs, for example. And you know, if you talk about a growth company with a forward PE of like 20, you're already seeing that it's a pretty cheap forward PE. If it's a value stock, you're going to be looking at something like PE ratios, for example. And you got to work out a valuation. It's good to always look at like historic values of the company, and that's the easiest way to look at it and go, well, this company used to trade at this valuation for so long, and not much has changed with the company. In fact, it's probably still in a very good place, and now it's at this valuation. And you can use historic values to look at it and go, that's a lot cheaper. So you've always got to be careful about the valuation of the company. You know, something like a Fastly, for example, being on an amazing run, but you look at the valuation of the company, way too much, and eventually it kicked in, and the stock dived that much because it was at just so much of a high valuation. And that's where you've always got to be careful of. Next up is the balance sheet. So the balance sheet is definitely a key thing in the company, and the COVID situation obviously is one of the big things that we didn't expect, but a lot of the companies that didn't have great balance sheets going into COVID are now paying the price for it. You've got to be looking for a company with a good balance sheet just in case of a rainy day and something happens. When it happens, it comes out of the blue. So you got to be ready for them sort of situations. No one knew a pandemic like this would happen, and the companies that weren't in the right position are now starting to feel that because they weren't ready for it. And you've got to look at how the company's managing that balance sheet, how much cash they've got on there, how much debt they're taking on. And having a strong balance sheet can be the really good foundation base for a company, and then can offer them growth. Because if they have a good balance sheet, they might be able to then look at a position and go, you know what, we could go buy that company, we can go buy that warehouse to improve our position, Whereas if you're in a company that is in a bad position and they need to grow, they're like, well, we're going to have to take on a 13% interest loan to go buy that company. We're going to have to go do that to go buy that warehouse. And that's something you've always got to look into. You know, I always like going for companies with strong balance sheets, ideally with no debt on them. Sometimes because of the industry there is some debt on them, but even a low to debt to equity ratio is a good thing as well. So I always looking for companies as well with strong cash positions. So yeah, that's something that can be really a make or break situation for your company. Next up is the management. The management are key to your company when you invest in, so you do need to have a look in them. You got to look at what kind of history they have with working with companies, the company they're in. I always like having founders of the company because they've been there from day one to where they are now. That's one thing that I do like seeing. But as well as that, I like seeing a generally quite an experienced management team. And also, if you can see that they've been successful with the company previously, that's obviously a bonus. If someone new comes into the company, I like to see where they're coming from. So for example, a bad management situation that I saw was when I looked into Ted Baker, and the new CEO they got into Ted Baker had previously been in a company that went into administration twice. And I was like, well, they haven't got a great track history, so I'm definitely not investing into that company. But at the same time, a great management can really lead the company going forward, and they can see the share price going up. You know, you look at someone like Elon Musk, for example, look at what he's been able to do for Tesla over the last few years, and that's a sign of a really good management. And the last one is kind of really with this kind of topic, which is how to pick a great stock. But when you do pick a great stock, just be careful how you manage that situation. You know, sometimes you can buy a stock and it goes down. So when you do find your stock, just be careful not to go all crazy at once and go, I found it, I'm going to go all in at once, because sometimes in the short term, stocks do go down, especially if they're on a downtrend. And sometimes, you know, just be careful when you do find that company, watch it for a little bit, maybe look at the valuation, maybe go, I'll just buy a little bit here, see where it goes, and then purchase a little bit more. When you do find your great company, don't go all in unless it's a very, very rare opportunity and you think it's just at crazy prices right now. Then potentially you might go in a little bit heavier than what you were planning on do. But I think in my history have ever saw a company and then gone 100% in all at once. I always average in over kind of a 3 to 6 month period after finding a company personally, and I think that always gives you a better average in price. So personally, that's one tip that I will get that I'm going to add into the end of this video. But hopefully you enjoyed it, hopefully you picked a few tips up in there, and like I say, I hope to do kind of more of these series where I'm not talking about actual stocks, I'm kind of giving a few tips out, and hopefully you found something useful. And as always, just in return, if you can smash the like button, that'd be much appreciated. If you are new around here, subscribe. If you are looking to maybe buy some stocks for the first time, I've got a link in the description which will let you open a Trading 212 account, so you can buy some stocks on there. There's also a link to an eToro account where you can buy some stocks on that one as well. So if you want to get started on the stock market and it's maybe one of your first videos on the stock market you're looking at, maybe that's useful for you anyway. But I hope you enjoyed it anyway, and I'll see you next video.